Hello everybody, it's Tortoise Investing coming at you today with 5 dividend stocks that you can buy and hold forever. I feel like we've got 5 strong ones here today. Today is Monday, August the 28th. This video will be released on Wednesday. I have a busy week ahead of me for work, so I'm trying to get a little bit ahead on my recordings. But if you're new, join the 552 that have already done so. Go ahead and hit that subscribe button. Hit that like button. Drop a comment down below. Doing all these things is super free, super easy to do, and I greatly appreciate it. None of this is financial advice. Just going to put that out there. Always do your own research before buying anything. Now, without further ado, companies we're going to be taking a look at today are Hershey, Texas Instrument, Canadian National Railroad, Texas Roadhouse, and Starbucks Corporation. Now, I do own Hershey, Canadian National Railroad, and Texas Roadhouse in my personal portfolio. Again, because I own it doesn't mean that you should, but these might be something that you want to take a deeper dive into and see if it's a good fit for your portfolio. So, Hershey Company, $218 off of a recent high of $275, I think it cracked. So, down a good bit, and I am buying little bits here and there whenever I'm able to dollar cost down a little bit and just add to it. Dividend yields over 2%, which is awesome for Hershey. It's got an adjusted free cash flow yield of 3.55%, a dividend yield of 2.19%, a payout ratio of 47.69%. All of those are green check marks for me. Revenue's been increasing at a rate of 6.75% over the last 5 years. And here lately, it does look like it is accelerating, rate of 13.07% over the last 2 years, so very nice. The free cash flow has been increasing at a rate of 12.76% over the last 5 years. Yet again, it is increasing over the last 2 years, almost 20% with the free cash flow. EPS been increasing at a rate of 16.69% over the last 5 years. Very nice again. Growing EPS, growing company, growing free cash flow. Everything looks good. Let's check the adjusted for stock-based comp. Not an issue whatsoever. There are a lot of companies where they'll have more stock-based comp than they do free cash flow on hand, and I hate that. Anyways, their debt, they have $3 billion in debt. Their EBITDA is $2.06 billion, so no issues there. Whenever I am looking for companies, I don't like companies have 3 times more debt than their EBITDA. So if this was that had $7 billion in debt, that'd be more than 3 times, and a little bit of a red flag for me. But that's not the case, so I like Hershey. Hershey's a pretty big position in my portfolio. So the dividend yield's been increasing at a rate of 9.41% over the last 10 years, and over the last 2 years, 15.02%. So they have been increasing these hikes even more. Love it. That is what you call a strong compounder. Share buybacks, not really too much to talk about here. Not much going on, but the return on capital employed. 2020, it was 19%. 2021, 20.37, and 2022, 21.8. So return on capital employed is growing, and I like that. I like that to be about 15% plus for all my companies that I look into investing. Hershey checks pretty much every box for me, and I like it. I'm very long Hershey. Next up, Texas Instruments. Adjusted free cash flow yield of 1.85%, has a dividend yield of 2.96%, and the payout ratio 58.53%. Now this one was very recently, I think, right at 186. So it's at 186, it's down to 168, so it's down about $20. Might be a good buying opportunity. Look into it, see if you like it. Revenue's been increasing at a rate of 6% over the last 5 years. Here in the last 2, compounding at a rate of 17.68%. So again, it is increasing quicker. Very nice. Free cash flow has been increasing at a rate of 7.33% over the last 10 years. Again, very nice there. And the EPS, just straight up and to the right, 20% over the last 10 years, 25% in the last 2 years. This is awesome. You love to see that. They have more cash than debt on hand. Another thing that I like to see. I love companies that have their debt under control, because that means when times get hard, they're safe. Dividend's safe. Everything is going to be A-OK. I don't like companies with a whole lot of debt. That bothers me, because what if something happens? What if there's a big downturn in the market? Those are the companies that are going to be in more trouble. So this company has more cash than debt on hand, and it looks like that's something that they usually keep going. So not an issue there whatsoever. Even if they didn't have any cash on hand, the debt's $7.89 billion. Their EBITDA is $11.48 billion. So they could just pay it off with their EBITDA or just what cash they have on hand. So yeah, very nice. The dividend's been increasing at a rate of 16% over the last 10 years. It has been slowing, it seems, 10.25% over the last 2 years. Not too big of an issue, though. Still nice compounding going on there. Shares outstanding, it looks like over the last 10 years, decreasing at a rate of 2%. Let's see here. It looks like from 2020 to now, they've increased their share count by about 3 million shares. So I don't know what that's about, but this is what matters. 2% over the last 10 years. Like to see that just down. Very nice. I love companies that do share buybacks. If you got a lot of cash on hand, you don't know what else to do with it, and your company's at a good value, buy back those shares. Let's see here. Return on capital employed is ridiculous. 2020 at 34.75%, 2021 at 40.5%, and 2022 41.8%. So that you could cut this in half, and it would be perfectly fine. But yeah, strong company. I like it. I've got my eyes on this. Next up, Canadian National Railroad. This is a very recent addition to my portfolio. I got out of Canadian Pacific. I know some people might be like, what? But the reason that I did that is the debt. Canadian Pacific's got a lot more debt on hand. We'll take a look at that in just a second. Adjusted free cash flow yield of 6.1%, dividend yield of 2.13%, payout ratio of 52.86%. Now the revenue's been increasing at a rate of 5.6% over the last 10 years, 11.26% over the last 2 years. So it is increasing. Free cash flow has been increased at a rate of 11.41% over the last 10 years. EPS has been increased at a rate of 9.29% over the last 10 years. And now the debt, $14.37 billion. Their EBITDA is $9.6 billion. So I like that. It's a lot more manageable than what Canadian Pacific was. I'll show you that in just a second. Dividend's been increased at a rate of 11.17% over the last 10 years. Shares outstanding have been decreasing at a rate of 2.38% over the last 10 years, 3% over the last 1 year. So they're increasing their share buybacks. Company they feel is on sale right now, so they are taking advantage of that. I like to see that. In 2020, the return on capital employed was 11.5%, 2021 12.37%, and 2022 14.61%. So that is also increasing, and I like it. Now, very quickly, let me pull up Canadian Pacific so you can see the debt. That's my big issue here. The debt $17.87 billion, EBITDA $5.65 billion. So that breaks my 3-time rule, and I just feel like it's a lot higher than CNI, and the return on capital employed with CNI is a lot better too. And the shares outstanding. They did just issue back some shares, but they've did some big acquisitions and stuff. I've still got my eye on it, don't get me wrong, but CNI, I like where it is more now than what Canadian Pacific is currently sitting at. Next up, Texas Roadhouse. I like this one a lot. This is another one I hold in my portfolio. As adjusted free cash flow yield of 2.52%, dividend yield of 2.02%, payout ratio 47%. Take a look at the revenue. Revenue's been increasing at a rate of 12.26% over the last 10 years. Very nice up and to the right. Free cash flow, again, 15.84% over the last 10 years, up and to the right. Stock base, not an issue whatsoever. I don't think any of these have an issue of stock-based compensation. That's one thing that just kills me with companies. EPS has been increasing at a rate of 14.78% over the last 10 years. We're not going to pay attention to this because the 2020 dip that everyone in the world had, that's throwing us off. And they're not increasing their EPS at a rate of 197%. That's not, when it comes to their debt, very little debt at $50 million. Their cash is $173 million. Even if that wasn't the case, they have more EBITDA than they do debt by like 8-9 times. So their debt is no issue whatsoever. It's another reason why I love this company. Very little debt, a lot of cash flow, growing revenue, growing dividend, 16.4% over the last 10 years. Look at that. It's just a set of stairs. I love it. Shares outstanding over the last 10 years, not too much, but here recently, look at that, 1.42%, and in the last year, 3%. So they have been nibbling back at some shares. I think they had a dip last year. It looks like they took advantage of that. So I like to see that. Very nice. Return on capital employed, they have the big 2020 dip, as again, pretty much everything in the world did. 2021, it was at 15.56%, 2022, 17%, and I'm expecting 2023 to be another increase. But yeah, Texas Roadhouse, strong company in my eyes. One of the best in the restaurant segment. Again, personal opinion. I love it. Can't brag enough about it. And lastly, Starbucks Corporation off a recent high of, $115 it looks like, down to $97. Just a free cash flow yield of 2.42%, got a dividend yield 2.22%, a payout ratio of 64.63%. So a little bit on the high side there, but manageable. Take a look at the revenue. Revenue's been increased at a rate of 9.26% over the last 10 years. Very nice, just up and to the right. Their free cash flow, 11.47% over the last 10 years. Again, just draw you a little line there. It's going to be up and to the right. EPS, 12.14% over the last 10 years. Again, up and to the right. Their debt is $11.87 billion. Their EBITDA is $6.29 billion. No issue there. Again, falls within the 3-time rule. And they even got some cash on hand, $3.18 billion. Dividend's been increasing very rapidly over the last 10 years. It raised 17.57%, but here recently over the last 5 years, 8%. So it has slowed down, but 8% is still a strong growing dividend that is beating inflation. That is nice. Shares outstanding over the last 10 years, 2.84%. Over the last 5 years, 4.54%. So they have been increasing the rate at which they were buying back their shares, which again, I love when companies do that. Return on capital employed, again, 2020 hiccup, 7%, but 2021, 20.9%, and 2022, 24.53%. And I expect in 2023, again, same thing as Texas Roadhouse, that to be increasing as well from the previous year. But yeah, 5 strong companies in my eyes, not CPI. We're going to put CNI back here. But 5 strong dividend growers. I like all of these, to be honest. I own about a lot of these. So always do your own research. Again, don't just buy it because I like it or I have it in my portfolio. But yeah, hope you've enjoyed that. Make sure to hit that like and subscribe button for more. And until next time, see yins.